For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
It is Managing Your Financial Future. Welcome back to the podcast. 100,000 downloads. We just got our stats in from last year. Rick Plum, you and I are very popular, I should say. Can I say that?
100,000 downloads? Wow.
100,000 unique downloads. Not bad for the little podcast that could, as I like to refer to this, Managing Your Financial Future. Well, it's good to know people are listening, and it's good to know people are getting something out of this, and I appreciate that. So, not that people care about stats so much, but, you know, it's just kind of nice. You hit that 6-figure before the end of the year. So, we're grateful to everybody for listening to this podcast. Make sure if you haven't subscribed, you do so. Apple Podcasts and Spotify. I'll remind you again here, I'm sure, at the end of the episode. But anyway, thank you very much for that. That's always nice. I'm your podcast host, Johnny Dean, and I've got my good friend here, Professor Rick Plum, certified financial planner professional, and, of course, accredited wealth management advisor. Now, here's a question for everybody. What should your investment strategy focus on the most? Now, I would say if you look at the headlines and advertisements, you might think it would be achieving the best rate of return. But let me give you a little different angle on that. And that is this. Once you stop obsessing, I guess, over rate of return and you start thinking in terms of, we'll say, dependable cash flow, the entire framework changes. When your income is steady, and let's say insulated, I guess, from market volatility, you gain the freedom to let your long-term investments compound. And you do so usually without fear or disruption and without being, I think, tempted to abandon your plan. Rick, would you wholeheartedly agree with that statement?
I like the statement. You started off by saying, what should you be focused on? And I'll go back to my famous 2-letter answer to everything. And the answer would be, it depends. As a 20-year-old, long-term rate of return is what you focus on. Mm-hmm. As a 70-year-old, long-term rate of return is only what you focus on some of the money. Mm-hmm. And stability, so now we've got different goals. Those two individuals, a 20-year-old and a 70-year-old, might most likely have different goals for their money. So if we're talking to retirees, the goal for the money isn't necessarily the greatest overall portfolio rate of return that you can achieve, because that entails quite a bit of volatility. Now, I do know some people who are in their 70s who have absolutely no need for any of any distributions from their portfolio, and they can focus on long-term goal because they're building it for their heirs down the line. But most retirees aren't in that situation. They need their portfolio to provide distributions to them, at least on an annual basis, usually a monthly basis. And when we're doing that, the primary focus, the primary goal isn't long-term rate of return, because if I need a check next month, that ain't long-term. That's short-term. If I need a check next year, that's short-term when it comes to being an investor. So we have to look at things differently and then create portfolios based on what we're trying to achieve. Well, and that those early years, rate of return, let's get to the bottom line. Rate of return is always important, but it's not necessarily the most important thing going when I need money next week, next year, even 2, 3, 4, 5 years around.
Yeah.
I need the money. I don't want to take the risk of losing money.
Okay. So, and you're right. The 20-year-old wants to have a great rate of return. That they've got 40 years, supposedly, presumably, 40 years, maybe 45. Somebody in their 20 has.
If they get incredible rates of return, maybe it's only 25.
Well, who knows?
But it's still long term.
Here's the thing. When I say focus on, maybe I should define that, because when you say, if you tell a 25-year-old, rate of return is important, and this is what you want to achieve. We believe you can achieve that over the long term. But when you say focus on a 25-year-old should focus on that, that does not mean that they should try to achieve that in the next 3 to 5 years by chasing that return.
Well, that's also not long term.
Well, it isn't the long term, but I think this is where people get confused, I think. Because rate of return is wonderful. Hey, even an 80-year-old would like a nice rate of return. But
now, I think I may have misspoke also. The 20-year-old's primary focus realistically is not long-term rate of return. Because unless they actually can pry the wallet out of their pocket and get some money invested, the rate of return means nothing. So for the young 20-year-old, the most important thing is to get money out of their pocket into the investment portfolio so they can actually start playing with the idea that they can earn some money, saving, discipline, moving money away from immediate spending. That's their main focus, not the rate of return. But then we get the rate of return after that.
Yeah, and that's echoes of last week's conversation that we had too. But would you ever tell? You would never tell a 20 or 25-year-old, even though they have all that time to save, to go out and try to pick the absolute best stocks and find the money manager with the best, historical. I don't think.
Well, no, we don't say necessarily a money manager with the best historical. Yada 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 yada. We're looking at. But we do tell you. I mean, unfortunately, we see this more often than we would like to see it. 20-year-old, 25, 30-year-olds investing in their 401k, investing in their Roth IRAs, and leaving the money in a bank account, or the Roth IRAs at the bank, because that's where you open Roth IRAs. No, that's not necessarily right. They've got their money in a balanced portfolio. They've got their money in a 2030 target date portfolio because they didn't want to take the risk. They're basically being too conservative with the money that they're saving now that they have a long-term, by definition, it's in a retirement account, a long-term perspective on them. So yes, we do tell people, you need to focus more on the volatility being your friend. Mm-hmm. You need to focus on A, savings, B, investing for the long term. Don't worry about the downturn because you're putting more money in next week anyway. So let's focus on the best potential rate of return that you can achieve going forward, without, gambling.
Over the long time period, though, and I think that's where you would say, because if they want to go aggressive, absolutely, be aggressive. You've got 40 years. But understand that going aggressive could mean that, I don't know, over the next 3 or 4 years, depending on how things go, I mean, you may not be getting a very good rate of return.
Getting a horrible rate of return, which for that 25-year-old is a great thing. Yes. Because that means they can keep buying on sale as they keep putting money in. They can actually accumulate shares when they're cheap. They want that volatility. They want to see it go down by 20, 30. They should want to see it go down by 20, 30, 40%, because then they can buy a bunch and let it recover later on.
Yes. So this goes back to my question of what should your investment strategy focus on? And when I say focus on rate of return for a 20-year-old, just understand that that's going to have to happen over a long period of time. Now, for somebody who's, say, 60, 70, I mean, they probably don't have 40 years. Maybe they do, but the odds are somewhat against them. But in their case, their focus should be more on cash flow, because presumably at age 65 or 70, you're starting to think about hanging it up, because you honestly probably don't, unless you absolutely love what you do. You're probably not going to be want to be chasing the paycheck into those years, and that's where I'm going with this, and I know where I'm going with this as well.
So the focus does shift as you get closer or into retirement. We have to find a way to create a portfolio to make a stable distribution so that we don't do what a lot of people unfortunately do. They take volatility, that is just a fact of life in the stock market, and they turn it into risk. Volatility by itself, we've talked about it before, is not risk. Volatility is a known issue. We know that the stock market's going to go up or down on any given day. We just don't know how much or which direction. That's volatility. We can use that to our advantage, as we just talked about for that 20, 25-year-old, for long-term investing, dollar cost averaging, all that fun stuff there. But for the retiree who has a need for distributions from the portfolio, we cannot let that volatility change itself from a temporary reduction in value with the potential for recovery to risk, which is the permanent loss of value. Don't want that. So we have to focus on how do we then create the cash flow. So, but the other thing is we don't necessarily look at the entire portfolio. And this is where most people get it wrong. They look at their entire portfolio as the generator, as if the entire portfolio has to be done in sync with the goal of cash flow. And in some respects it does, but you don't manage the whole portfolio, because that means you're going to have a balanced portfolio by definition. You're either going to be all bonds to try to create the interest only aspect of it, which means right now you're earning about 4% with absolutely no chance of growth, and meaning you'll never have an inflation bump, and you're not going to keep pace with inflation, and you're just going to be slowly going broke, or you're going to be too aggressive and have too much stock, or you're going to have a balanced portfolio which still has volatility. And when you're taking distributions from a potentially volatile portfolio, you are introducing risk. Mm-hmm. Sometimes it works really well, but sometimes it does not work at all. And even in good years, we've talked about this before, there are down months. This year, or last year, 2025 ended up pretty decent year. But I remember towards the beginning of the year, February, March, April, it wasn't looking very pretty. It was looking kind of ugly. And if you were taking distributions from your balanced portfolio at that time, you were turning volatility into risk. You were losing money because you were selling more than you needed to sell to be able to get the same goods and services you got the month before. That's why we need to then basically bifurcate or segment your portfolio into specific goals. You no longer have one goal. You have multiple goals. You're 60, 65 years old. You need cash to live on in the next couple of years, 5, 10 years. That cash should be invested differently than the money that I don't need to spend for 15, 20 years. You have different goals. So we invest it differently. Money I need to spend next year, that's safe. That is if I need 50,000 next year, I should have 50,000 in CDs or something like that, so that I know the 50,000 is there. Now, once I've got the primary goal there of preservation satisfied, now I'm going to try to get the best rate of return I can for that particular goal. Now, on the other side, I've also identified that if I've done this correctly, I've put enough money in bucket one to satisfy my cash distribution needs for the next 5, 7, 8, 10 years. Now I can start taking more risk, now I can start putting things at with more volatility to get even a better rate of return, because distributions are not the primary factor at this moment. They will become primary after 6, 7, 8 years, but I've got that time period covered.
Now, everything in life comes with a cost. Everything good comes with a cost. Even a bucket strategy. I mean, there is a fee, not a fee, I shouldn't say that, but a cost.
There's an opportunity cost.
Yes.
If the markets do nothing but go up, you're being too conservative. If the markets do not have a bad time, a bad month, a bad couple of months, a bad year, but like I just said, 2025 was a good year. It had bad months. 2022 was a bad year. Mm-hmm. 2020 had some significantly bad months, but it was a good year. You can't tell when it's going to happen. And most people in 2020, if we go back to that, they expected it to go down a lot longer and take a lot longer to recover than it did. I remember being in there thinking, well, this is going to be a long one. And it recovered in like 2.5 months, 3 months. So you cannot predict when it's going to go down, or for how long it's going to stay down, or when it's going to turn. I remember back in March of 2009, which was the great financial crisis or great financial reset, whatever they wanted to call it back then. And all the news reports in February, March was It's going to be a long one, folks. It's going on for a long time. There is no sign of recovery. There is no chance this is coming back. And then March 9th happened, and it started coming. The news was dire. I mean, everybody was doom and gloom and pessimism. And on March 9th, the market said, I'm not listening to you anymore. We're heading north. And it did. And it did really well from that point.
There really was no sign. And there was no, if you look back, why was it March 9th? Nothing happened. It just happened.
No news reports came out. No studies came out.
And I think the mood just changed somehow, and the momentum changed. But
obviously.
But you look at this, and I've read this too, when they say, well, what was a good year? I don't know, 2024, we had a couple of good years in the teens,
2021 was a good year. 2021 was a very good year.
Yeah. And I've heard people say, you mentioned the opportunity cost, and they say, well, wait a minute now. I mean, if you're telling me that I got to put, say, up, maybe a third or so of my portfolio into something back then there was earning basically nothing. It was
almost nothing. Yeah. 0.5%, 1% was good and saved money.
Yeah. So wait a minute. Now you're telling me I got to put a third of my money into something that's earning basically nothing. You're going to tell me to put maybe another third-ish of my money into something that's pretty watered down, maybe better than the first third. And I've only got, 35 something percent potentially of my money going into into equities. I mean, people looked at that and they say there's something wrong with that. And this is the mentality that I think that we need to change among people, because they're saying, look what I missed out on. But Rick, I'm
not missing out, because most of the time they see the value in it, because the markets do correct at times. And what the idea of having money in what we call bucket number one and potentially bucket number two does is, when the markets do, if you're going for you're going for gusto, you're going for broke on this stuff, and you don't want to miss out on any opportunities. Well, guess what? You're not going to miss out on all the opportunities, and you're going to catch everything the market does to you. But emotionally, that upside makes you think, oh, I'm invincible. All right, right up until it doesn't work for you. And when the market starts to head down, whether it's in 2020, in the COVID, you're thinking, oh my gosh, I need to sell everything before I lose everything. And people rush to sell. In 2018, the market was down. People sold like crazy. 2019 was a very good year. But the problem with doing it the way you were talking about, and not wanting to miss out anything, is they don't miss out on the downturns either. And the emotional aspects of it drive them to drink, but they jump out of the market at the wrong times, and they jump into it at the wrong times.
And this is what happens when you try to chase rates of return, chase yield, chase rates of return. And I knew where you were going with that. When you try to say, I'm going to get nothing but the best. I remember, well, you remember even in the late 90s. You remember? I mean,
I remember we were doing buckets in the 90s, and through the late 90s, if you remember, for those of us who are old enough, 96, 97, 98, 99, they were all 20+% years as measured by the S&P. I mean, the radio shows were like, you couldn't swing a dead, anyway, and not pick a winner in the stock market. It was just going up crazy. I remember you put your safe money when you think you've sold out of a stock at the high and you're looking for another one to buy. Put your money in the QQQ, which is the NASDAQ ETF. That's the safe way to do things. Oh, that's BS.
Oh,
but the problem is,
heard that.
I wasn't making that up. That was real. Mm-hmm. We doing buckets, where in bucket number one, we were getting at that time guarantees of 5-ish%. In bucket number two, we were getting guarantees, now guaranteed by an insurance company or guaranteed by a bond or something of that nature, of 7 and 8%. And then we had the stock market for bucket number three. Those weren't bad rates of return, but people thought we were too conservative. And, Alan Greenspan had his famous speech in 96. 97 was positive. 98 was positive. 99 was positive. We didn't all die at Y2K. The world didn't come to an end. And the first month or two of 2020 was looking like a continuation. People said Mr. Buffett had lost his way. The old ways don't work anymore. We had a new paradigm, and those people don't even have a paradigms anymore because the market crashed on them. And so what was that? March 20th of 2000 was the high point.
I remember it as the 10th, but
mid-March somewhere. And it went down, and it went down, and it went down. When that bubble busted, and we went from being holy crazy too conservative to geniuses in about a month.
Well,
and we didn't change what we were doing.
No, but it's very hard during very good times like we had, especially during bubble times, to convince somebody that you need to have cash flow rather than focus on rate of return. And by the way, it happened again. We learned our lesson in 2000. Well, guess what? 2006 and 7, totally forgotten yet again because people were back into the other bubble, which was
greed,
the housing.
Human emotion.
It never goes away. I read a great quote by Harry Truman once. And he was talking about generations, but this is true of investing generations too, which can only last 7 or 8 years sometimes. And he said the next generation never learns anything from the previous one until it's brought home with a hammer. And this is exactly what has to happen. And even though people have to be constantly reminded of this, that good times don't last forever. If you are going to chase return, I mean, even if you have a 40-year time horizon, if you're going to chase return, there are people, you're going to be in big trouble. There were people in their 20s, Rick, in the 1990s who were chasing and chasing and chasing and achieving for a few years.
Yes.
And then got wiped out.
And there was that tech, and if you weren't in tech, if it didn't say .com at the end of it, you weren't making any money. But that wasn't a true statement either. There was a lot of good quality stocks that went up with not as much. They weren't going up 100% a day like some of the things seemed to be doing, but they were doing very well, and they did falter in 2000 to 2001 to 2002. But guess what? If I held on to those good quality companies that were good quality companies, yes, they lost money, and they lost a lot of money in value in 2000 to 2002. But can you imagine where you'd be today if you still had it 25 years later? Even 15 years later, you were okay. You were doing good.
Well, and so the point of this, of course, is to talk also about don't chase return.
Chasing return, it tends to feed into the two most basic investing emotions that screw you up: greed and fear. Mm-hmm. Yeah, you're greedy, so you're fearful that you're going to miss out, and then you're fearful that you're losing it, and you want to hold on to what you have, and so you sell out. I always consider it this. Somebody told me this years and decades ago now. Most investors follow this one buy, bitch, ditch theory. When the markets are on fire, they start to buy. Then the markets turn and go down, and they bitch and they bitch and they bitch until they can't handle anymore, and they finally sell, and they ditch the stock. And that's about when the markets turn around, and they watch it come back until it goes on fire again, and then they buy again when it's near the top, and then they watch it turn. So they're always buying on the high side and selling on the low side. And the metrics of money going in and out of the market bear this out. It's just we have to take that kind of emotion out of it. When we're chasing return, we chase it at the wrong time. In fact, this is where value averaging has such a strong play. When the markets are on fire, now this is for retirees more than it is for that 25-year-old, because the 25-year-old should ignore all this noise and just keep prying the wallet out and getting money into the investments and letting it and buying and buying and buying and buying and buying and buying. But for the older folks, myself included, we need to look at what we're doing, and when the markets are on fire for a couple of years, instead of thinking this is the new paradigm and it's always going to be higher, let's take some cream off the top. We set a plan up that works if your assumptions are, X, and we've done double or triple X on our long-term growth. Let's take some of that cream off the table and let's put it into something safer. Buy some time for those inevitable, don't know when. I'm not saying it's happening tomorrow. It could be happening today for all I know. I've watched. it could be happening. I don't know when it's going to happen, but you don't want to freak out when it happens because it's an expected issue.
Well, what we've seen here is that, the BBD is what we'll call that. That was the type of, it's incredibly common. Now,
does it make sense?
It does make sense. And this is the whole point of why we're talking about this. But when somebody, especially let's say somebody who is retired, I'll focus on somebody who has left the workforce. When somebody has an income, when they have a cash flow, and it's covering all of their short-term needs, what kind of investor does that make? Doesn't that tend to make them a little bit more rational?
It makes them much less emotional. Yes, if you've got all your income needs covered from day to day, month to month for the next X number of years, 5, 8, 9 years, whatever the safety factor you want to build into this is, you understand that the market, if it goes down, the biggest anxiety you have when the market goes down isn't, oh my gosh, I'm losing money. It's where can I buy in? Where can I get some cash to buy in? This is a buying opportunity. This is not a scary thing. It's expected. We just don't know the date. And we want to have, if possible, some dry powder. That's where value averaging, especially if we have positive markets in the early years of your distribution strategy, building up some dry powder and being able to buy in when it's on sale. That's a great thing.
Yeah, so having those short-term needs covered by something that is outside of the volatility of the stock market, they cannot be taken away if you happen to go into an extended down period like we had in 2000, from 2007 to, and as you said, 2009. I mean, that was just the bottom of it. I mean, we didn't get back up to even for a couple of more years at least. So that was a long stretch where there was a long dry period there. But if people had during that particular time period, as you saw, their income needs covered, their cash flow needs covered, they may not have liked seeing their bucket 3 go down, but it didn't affect them.
Nobody likes it, but it's a fact of life. And as long as we don't sell, we don't turn it into a permanent loss.
Well, and this is why we focus on cash flow much more than focusing on rate of return. And I don't want to say there's anything wrong with rate of return. We all want a good rate of return. But when you go after it, when you chase after it to try to get it year after year after year, you're going to lose, in my opinion. And I think in your opinion, too. I mean, you may not lose in 1 year. You went very well from 1996 to 1999 or 2000, and you got big-headed. But in every single instance, it wound up costing you. And you just cannot maintain that. I think the only way to really do this, Rick, is to allow compounding, which takes years, but allow it to do its job. And in the meantime, buy the time that you need by having that cash flow to get through all those volatile years.
It's that distribution from the portfolio that really matters. Because if you are taking a distribution from your portfolio, sure, when it's going up, life is rosy. But when the markets have a downturn, and like I said, we haven't had a massive one like 2007 to 2009 lately, but we had 2018 was a negative year. 2020 had a bad portion to it. 2022 was a down year. Every year has had down portions in it. 2025 had the early portion of the year, then it came back. If you are taking distributions during those down times, you're shooting yourself in the foot. Because that money, you had to sell more of whatever you had to get the same amount of money out, cash, that you did the month before, the year before. And that whatever you sold that you then spent, it's not there anymore, obviously, and it cannot recover.
Yeah.
Time heals all wounds if you can let it recover.
That radio show host that said, "I'm putting my safe money in the QQQs." I will never forget that. And this was 1999. That same radio host, when we were talking about buckets, said one time to me, he said, "There is no way I'm putting more than 15% of my portfolio in anything safe." He said, that's a fool's game. Now,
how old was that guy at the time he was saying
30. I don't know.
He was in his mid-30s.
I would say 35. Yeah, between 35 and 40. Yeah.
Yeah. So his goals were completely different than a retiree who was listening to his show.
Yeah, exactly. Well, and that was my point with that. Yeah. I mean, you don't have to have. Let's go back and just clarify. We only got another minute or two here, but just to clarify here, when we're talking about somebody, as you said at the top of this episode, who's 20, 25 years old, you're not going to partition out 35, 40, 50% of their portfolio into something non-volatile. That's just no. And I want to.
But let's look at why are we investing that 25-year-old if the money he's putting aside is for an emergency fund?
Mm-hmm.
I'm going to put it in something safe. We have to look at the purpose. What are these funds for? Are they for me buying a house in a year and a half? I'm not necessarily going to take the market risk with it. Although maybe I'll say, a year and a half, 2 years, 3 years, whatever it takes, I'll be more aggressive with it. If it goes, but we have to look at why, whether we're the 25-year-old or the 85-year-old. Why are we investing these specific dollars? Not the entire portfolio.
Mm-hmm.
Let's identify these. So I may have a portfolio that has room for an emergency fund and then also for long-term growth. They're different goals, and I need to apply the appropriate investment to the individual goals for the specific monies that we're talking about. Similar with a retiree. They have a goal of taking X amount of dollars out of their portfolio forever. But the money I need to take out for the next 5, 6, 7 years has to be more secure and safe than the money I don't need to withdraw for 15, 20 years. Different time horizons, different needs, different investments to support the different time zones, the different periods, the different goals in your life.
100%. We're about out of time here, but I think if I wanted to wrap all this up in one sentence, I would say that chasing the highest return rarely leads to the best result. And over the long term, I mean, if you're going to try to chase the highest return for the next 6, 7 years, I don't know that it would ever work at all. In the end, especially for the retiree, it's the steady, sustainable cash flow that keeps you invested, that keeps you calm, as you said, Rick, and keeps your plan on track. And I think that's what matters the most over a retiree's.
And the problem is it does work for some people because they get lucky at the right time, and they're the ones you hear about in the news.
Well, let's go back to Harry Truman, who says they won't learn the lesson until they get hit, until it hits them like a hammer. So just keep that in mind. I try to remind people of this every so often. Give the advisors, by the way, at Lucia Capital Group a call, 800-644-1150. If you haven't guessed, they've been doing this stuff for a long time, even when it wasn't fashionable to do so back in the dot-com eras and back in the 06, 07 housing bubble. Give them a call, 800-644-1150. Rick remembers these people well. By the way, speaking of Rick, he oversees the financial planning department there at Lucia Capital Group, and the entire team does collaborate on strategies that are designed really to help you build and maintain that retirement income. Now, don't forget, you can also visit luciacap.com, LUCIACAP.com. Find more information on everything we cover here, and along with our downloadable guides. Got a lot of those free guides, Social Security. Download that, estate planning, retirement income, bucket strategy. Just type whatever topic you're searching for into the search bar at the top, and then download whatever you need. They're all free, of course. And don't forget to subscribe to this podcast. One last time, I'll remind you, Apple Podcasts or Spotify. Listen to and download each episode. I can almost guarantee that you'll pick something up useful every single time. All right, we are out of time. Thanks so much for Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. I'm your podcast host, Johnny Dean, managing your financial future. Thanks so much for listening. Talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. All performance referenced is historical and is no guarantee of future results. This material should not be considered a solicitation of an offer offer to sell and buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. A value averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. Stock investing includes risks including fluctuating prices and loss of principal. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59 and a half or within 5 years of the date the Roth IRA was established, whichever is longer. Before investing, carefully consider target date funds investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Bond yields are subject to change. Certain call or special redemption features may exist which could impact yield. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. The S&P 500 is a stock market index tracking the stock performance of 500 of the largest companies listed on stock exchanges in the United States. Indexes are unmanaged and cannot be invested indirectly. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. Any other individual or company mentioned in this podcast are not affiliated with or endorsed by Lucia Capital Group or LPL Financial. LPL Financial Insurance License number 0518721. LPLIN Insurance License number 0B91442.